Good morning, everyone. Myself, Vivek Banerjee. I will be taking today's lecture on valuation of equity shares. And in my previous lecture, I have discussed the various, can say, points regarding various concepts of valuation of equity shares. Today, I will be taking the assignment portion. Before that, some of the portions have been left, that is cash flow models, enterprise value. Good morning, Shruti. Cash flow and enterprise value and valuation of preference shares. Just I will revise you what we have studied during our last lecture. We have started with the concepts of used in valuation of equity shares, such as internal rate of return, discount rate, and the required rate of return. And generally, the required rate of return is used as the discount rate for, you can say, calculating the present value of future cash flows. Then we come to the nominal cash flow, the concept of nominal cash flow and the real cash flow. Nominal cash flow means the cash flow without adjusting any inflation. And real cash flow is the cash flow which is arrived at after adjusting the inflation. So in case of nominal, correctly, therefore in valuation of equity shares, nominal rate of discount is used. Then we shifted to the concept of equity risk premium and market risk premium. We have also seen that cost of equity capital can be calculated by two methods, by Gordon's method as well as by the, we can say, the CAPM model. And the Gordon's method, as you know, it is P1 upon P0 plus G, which is actually the this reverse of while we calculate Gordon's model as per valuation of equity shares. And the CAPM model, we have used this formula, risk-free rate RF plus beta into RM minus RF. That is, RF is risk-free rate, beta signifies volatility, how volatile the stock is in comparison to the index, that is the either Nifty or Sensex. RM is the market rate of return, and RF is risk-free rate of return. So cost of equity can be calculated both these methods. Now, which method to use? Generally, where the company is following a continuous dividend policy, the company is paying dividend for a continuous period of time, then the discount rate which is used is the Gordon's dividend discount model. That is, this discount rate is generally this is actually used. And in case of the company which is, you can say, capital intensive and the amount which has been raised through equity into the project is considered to be risky, then the CAPM model is used. This is the CAPM model. So KE is calculated as per CAPM model, and this is the Gordon's model. This is the Gordon. Yes, good morning, everybody. Okay. Then we come to the dividend discount models, various, you can say, techniques of valuation of equity shares. First of all, dividend discount model. Then we come to earning based model, then the free cash flow based model. In dividend discount model, basically the Gordon's method is used, and there are various aspects. That is, first aspect is that when the dividend, the investor wants to hold the shares for up to 1 year, then the future dividend, that is dividend received after 1 year, is discounted to arrive at the present value, and any market price after 1 year is discounted to arrive at the present value. Then we have taken that if the investor wants to hold the shares of a company for a long period of time, then the Gordon's formula, which is D1 upon KE minus G, is used. So this formula is used when it is assumed that the growth rate of the company will continue for a long period of time, till perpetuity, indefinitely. Okay. And to the first method which is used is the zero growth, and the second we have come across is the constant growth rate. Means the company is paying dividend at a 10% growth rate every year. These two situations, first two, the zero growth rate as well as the, you can say, continuous growth rate, is impractical, because in reality you see that the companies declare dividend, different amount of percentage of dividend for every year or after a gap of some years. So the practically what is followed is the variable discount rate, the variable dividend policy. We have seen two aspects of this. The first is the two-stage discount model, and the second is the three-stage discount model. In the two-stage discount model, it is generally assumed that for the first few years, 3 years, 4 years, 5 years, the growth rate increased exponentially. The rate of increase in dividend growth is very high, say for 20%. Then after some time, after 4 or 5 years, it stabilizes and the dividend growth rate say come to 10% from 20%. So at this 10%, this will be considered as the normal growth rate, which will continue for a long period of time till indefinite. So when we assume that yes, the growth rate will continue till perpetuity, then this Gordon's formula is used, continuity formula is used. Another very important aspect of the Gordon's concept formula is that the KE is greater than G. That is, the cost of equity capital is always greater than the growth rate. So this is one of the very important assumption of the Gordon's model. Therefore, there it is written in the denominator, it is written as KE minus G. Then we came to the three-stage discount model. Three-stage discount model is calculated in the same way as two-stage discount model, but there is a variation shortcut to calculation of three-stage discount model, which is the H model, we say. In this case, the only difference is that what is the transition period? Half of the duration of the transition period is taken. Say for certain number of years, 4 or 5 years, the dividend increase at a growth rate of 20% for first 4 years, say. After 4 years, it declines at 3% for next 3 years. So this is called the transition phase. So in H1 model, the half of the duration of the transition phase is taken. For example, if the transition phase is 3 years, for 3 years, the discount rate is declining by 3%. We have taken example on this also. Then half of the duration of the transition growth period will be 1.5. That is 3 upon 2. And these two methods, the answer will be vary, because in this case, every discount rate is not taken on the transition period. Only the half of the duration of the transition growth period is taken. Then we come to the earning-based model. In earning-based model, the Gordon's method is also followed. And basically, the earning-based model is followed when the company has growth opportunities. The company is not declaring dividend frequently every year. So earning-based model is followed in such cases. Then we come to the cash flow-based model. Practically, in majority of the cases, the cash flow-based model is generally followed, especially in case of, you can say, capital-intensive industries where either the company is paying very high dividend or low dividend or not paying dividend at all. So cash flow-based method is more frequently followed by the companies. There are two aspects of free cash flow to firm model. That is FCFF and FCFE, free cash flow to firm and free cash flow to equity. As we discussed in your previous lecture, that free cash flow to equity is basically a unlevered cash flow. It is an unlevered cash flow. So what is an unlevered cash flow? Unlevered cash flow means in this cash flow, you can say equity and debt holders both are considered. The obligations of all the stakeholders are considered. So the impact of interest and debt is not taken into account. Is not taken into account. Is not taken into consideration. Therefore, the formula, I have mentioned it earlier also, that FCFE, it is calculated as NOPAT, that is net operating profit after tax plus interest. Tax effect is also taken plus depreciation minus capex, that is any capital expenditure, and minus any changes in working capital. So these cash outflows are deducted and any cash inflow is actually added. The interest is added because the impact of interest should not be taken, because in profit and loss account interest has been deducted, but such impact of interest is not taken in case of you can say free cash flow to firm. This is actually free cash flow to firm, actually free cash flow to firm. Okay. And then we come across the free cash flow to equity, which is basically called the levered cash flow. Why levered cash flow? Because in this case, the debt and interest are, you can say, adjusted. So this is the cash flow, that is free cash flow to equity is the cash flow which is available to the equity shareholders, and free cash flow to firm, the cash flow is available both through debt and equity. That is why it is called the unlevered cash flow. Okay. Now, how so? If FCFE is called the levered cash flow, that is the impact of debt is taken and impact of interest and debt is taken. Impact of debt and interest is taken. So it is calculated as NOPAT, that is net operating profit after tax plus depreciation minus capex, any capital expenditure is deducted, minus any change in working capital is deducted, then any new debt raised, because if any new debt is raised, cash flow is coming, therefore it is added, and any debt which is repaid is also deducted. That is, it is a cash outflow, therefore it is deducted. If you observe that in this case, the free cash flow to equity, the interest is not added. The interest is not added because the impact is already taken in the net profit and loss account. Because in the net profit and loss account, it is already deducted. Therefore, the impact of interest is not taken. Depreciation is obviously added back to arrive at the cash flow. So this is free cash flow to firm and free cash flow to equity. Now come to the another very important concept, that is enterprise value. What is the enterprise value? Enterprise value is considered as the true economic value of a company. In simple language, you can say enterprise value is also called the acquisition value. It is also called the acquisition value, or it is the value at which the other company may purchase it. So it is also called the merger and acquisition value. For example, there is a company ABC. You can say company ABC, and this is the another company PQR, and this PQR is want to actually acquire this ABC. This PQR is want to acquire this ABC. For this purpose, when PQR will acquire this ABC, not only ABC's equity, but also its debt will become the, you can say, the property of the PQR. Therefore, debt and equity both are considered. Okay, that is why in this case, not only market capitalization, here you see that how it is calculated. It is calculated by adding market capitalization, long-term debt, minority interest, minus cash and cash equivalent. Yes, purchase consideration, Suraj. So it is market capitalization plus long-term debt plus minority interest minus cash and cash equivalent. So how enterprise value is calculated? Not only debt, but both debt and equity both are considered. So market capitalization, that is the current market price per shares multiplied by the total outstanding shares, which is the market capitalization. Long-term debt is added, minority interest is added, and any cash and cash equivalents are deducted to arrive at the enterprise value. Now, what is this concept of minority interest? Some of you might be wondering that what is minority interest is. Actually, minority interest is the value of those subsidiaries which are not actually, you can say, owned by the holding company. Means where the stake of the holding company is not more than 50%, 20%, 30% say. And if it is less than 50%, then basically the financials of those subsidiaries are generally not included in the financials of the holding company. That is why the reason is that is why while calculating enterprise value, the financials of those companies are generally the value of those companies, those subsidiaries which are not owned by the holding company is included. That is what is called the minority interest because those subsidiaries are in the minority. So in order to have a true value, the value of those subsidiary companies are also included, which are actually not owned by the holding company. So this is what is the concept of this. Yes, it can be 20 to 30% stakeholding, minority interest. Minus cash and cash equivalent. That cash and cash equivalents are also deducted because if PQR is actually acquiring this ABC Limited, then some amount of cash is also required to be paid for the expenses, the obligations of the company. Therefore, cash and cash equivalents are deducted from this while calculating this enterprise value. Now come to enterprise value to sales. Enterprise value to sales is also a method to judge that whether a company is undervalued or whether a company is overvalued. So if enterprise value, I will denote it by EV, enterprise value upon sales, the ratio is high. It indicates that the company is overvalued, the company is costly, and it is, you can say, costly to acquire such company. And if the EV by sales is low, EV by sales is low, the ratio is low, then it can be considered that the company is actually undervalued and it is cheaper to buy such companies. Now come to enterprise value to EBITDA, that is earning before interest and tax, depreciation and amortization. And it is also known as the amount available to debt and equity shareholders of the company, that is EBITDA. This multiple is used for valuing capital intensive companies which generally have substantial depreciation and amortization expenses. Student, this is the second sentence is important, that this enterprise value to EBITDA, when it is used for valuing capital intensive companies where more capital is required. For example, manufacturing companies, which generally have substantial depreciation and amortization expenses. So in case of those companies, the enterprise to EBITDA value is useful. Now come to valuation of rights. As we know, that company offers right shares to existing equity shareholders. And immediately after the right issue, the price of share is called X right price, or it is called the theoretical X right price, means after the issue of the right shares. So you can see it is computed as NP0 plus S upon N plus N1. This is very simple formula. What is N? N is the number of the existing equity shares, and this P0 is the price of the existing shares. This NP0. So what is this NP0? NP0 is basically, you can say, the existing capital only. This NP0 is the, if you observe, this NP0 is the existing capital only because N is the existing equity shares and this P0 is the existing price, means before the issue of the right shares. So it is the existing capital, and S is basically the subscription amount. S is the subscription amount, means total amount to be raised through the right issue. So basically what NP0 plus S is, these two amounts is basically the total amount, that is total capital raised after the right issue. Means so the total capital before the right issue plus the amount raised through right issue, both are added to actually find out the total capital which remains after the right issue. And then now come to this denominator, that is n plus n1. N is basically the number of existing equity shares and N1 is the number of new shares. So existing equity shares and number of new. So what is N plus N1? It is the total shares, means shares before the issue of the right shares and the shares after the issue of the right shares. So if you merge these two points, then it will be the total number of shares after the right issue. So this way, the theoretical X-right price is calculated. Suraj, can you please clarify? I'm not getting your query. Shruti is asking how enterprise value is different from valuation of shares. Actually, enterprise value, you can say, provides impetus, provides, you can say, a support to actually find out the support to valuation, because valuation, we while computing this, we only concentrate on the this valuation of equity shares only, and we calculate the enterprise value, we are concentrating on the value of the whole company as a whole. And this is from the point of view of the acquisition. If another, what will be the price if another company wants to acquire our company? That is the basic purpose of the enterprise value, to find the value of a company as a whole. And when in case of valuation of equity shares, we mainly concentrate on the if the investors, as an investor, I am investing in the shares of any company, what should be its value? So you can say valuation of equity shares, you can a narrower concept, and the enterprise value is a more broader concept. No, this is not similar to actually diluted EPS. Diluted EPS, it is somewhat different. In this case, the convertible portion is actually not taken into account in diluted portion. So it is different. No, Shruti, it is actually, if you see that the this ratio is different. Enterprise value to sales is enterprise value upon sales, and enterprise value upon EBITDA is enterprise value to earning before interest and tax, DA. So these are two different ratio, and approach is different. Enterprise value to sales is more or less a broader concept, in which case, if it is, if the valuer is of the view that yes, the enterprise value to sales, the proportion of enterprise value to sales is higher, then the company is overvalued. It is better to, you can say, is more costly to purchase that company. And if the enterprise value to sales is less, it is, you can say, cheaper to buy that company. And enterprise value to EBITDA is basically, you can say, if enterprise value to it is higher in comparison, it can say that yes, the company is valued more in comparison to the profit. And it is also showed, you can say, the value of the company. If enterprise value is higher, obviously the value is considered to be higher. But this actually, this ratio is generally used in case of those companies which are capital intensive, That is the, because this EBITDA is the value is to be arrived before depreciation amortization. Therefore, this ratio EV upon EBITDA is used in case of those companies which have capital intensive, which means which require more capital, as it happens in the case of manufacturing companies, which manufacturing companies which have substantial capital, which includes substantial capital, and which uses their capital in purchase of fixed assets, have substantial depreciation and amortization. So it is this ratio, that is enterprise value to beta, is basically fruitful and basically beneficial in case of those companies which are capital intensive. Vansha, enterprise value versus market capitalization, there is a very vast difference between these two. What is market capitalization? Market capitalization is the market price per share, current market price per share multiplied by the outstanding shares. And in enterprise value, not only market capitalization, but the debt value is also taken. So enterprise, the concept of enterprise value is broad. The concept of market capitalization is narrow. Because in market capitalization, the emphasis is only on the shares. But in case of enterprise value, the emphasis is not only in equity shares, but also debt. Now, we are discussing this valuation of rights. Okay. So, I hope it must have been cleared how theoretical X right price is taken. I will take a practical question also on this. And then, how theoretical value of right? First of all, we calculate the theoretical X right price. So for calculation of theoretical X right price, this is the formula. And then we calculate the value. So how value of a right is calculated? It is X right price minus subscription price. It is X right price minus the subscription price. So here I will take the question of assignment on this right share so that it is clear to you at this moment itself. That is valuation of right share. So let us take the assignment question first in case of valuation of rights. So this is the question. Come to question number 8. Question number 8, I hope you must have uploaded it, downloaded it. Otherwise, you may take a screenshot and solve this question along with me. So let us come to this question, question number 8 of your assignment, which is related to valuation of right shares. ABC Limited shares are currently selling at 13 per share. Okay, so what is the existing price? Existing price is rupees 13. And there are 10,000 shares outstanding. Outstanding shares are 10,000. So if we see the formula here, valuation of X, right? So this is P0. P0 is actually the existing price. In this case, it is rupees 13. And 10,000 shares outstanding, it is basically N. That is the number of existing equity shares. Now, what is given in the question? The firm is planning to raise 20 lakhs to finance a project. The firm wants to finance a project and it needs rupees 20 lakhs. Okay. How will it fund it? It will fund through the right issue. Fine. Now, what is required? Required is what is the X right price of shares and value of a right if number one, the firm offers, let us take the number one position first, portion. The firm offers one right share for every two shares held. So first of all, let us try to calculate this first portion. This is answer to question number 8 of the assignment portion. We will take the first point. That is, company is issuing one right share for two shares held. So this is one right shares for two equity shares held. Now, what will be the total right shares which will be issued? Total existing shares, it is given in the question. Total existing shares is this. This is the total existing shares, 10 lakh. So half of 10 lakh will be 5 lakh because one equity shares for one right share for two equity shares. So total right shares will be, it will be 10 lakh divided by 2 is 5 lakh. 5 lakh right shares. Now we will calculate the X right price. X right price, that is price after the issue of right shares. So we will utilize this formula. You don't need to actually write the formula also, because if you see the PPT, this is so what is in the numerator while calculating this X right price? Numerator is the total capital, existing capital at well as the capital issued with the help of the right issue is the numerator, and denominator is the total shares, means shares before the right issue and shares number of shares issued through the right issue. Okay, so this is very can be solved very logically. Let us so X right price will be total number of shares is 10 lakh. 10 lakh shares multiplied by rupees. What is the price? Price is 13. This existing price is 13. So multiplied it by 13 plus the subscription price. That what is the subscription amount? This 20 lakh has to be raised through right issue. So it will be plus 20 lakh divided by the numerator, which is the first, the total existing shares. Existing shares are 10 lakh. And what is the number of right shares? Right shares are 5 lakh. So let us calculate it. Is 1 crore 30 lakh plus 20 lakh. It's coming to 1 crore 50 lakh. And 10 lakh plus 5 lakh, it is 15 lakh. So let us calculate it. 1 crore 50 lakh upon 15 lakh, it is coming to 10. Rupees 10. So rupees 10 is the X right price. Now we will calculate the value of right. So value of right, what is the formula? Let us see this here. Value of right is equal to X right price minus the subscription price, this portion. Value is X right price minus subscription price. So it is X right price minus subscription price is equal to X right price is arrived at 10 and subscription price okay, we have to calculate the subscription price also in case of right issue. The subscription price is to calculate the subscription price also. Subscription price of the right issue. So number of shares, right shares is basically, one second. The total amount to be raised through the right issue is, 10 lakh. Let's see, the total amount to be raised through the right issue is the 20 lakh. So 20 lakh divided by rupees 20 lakh divided by the number of shares, which is 5 lakh. So it is basically coming to rupees 4. So this is the subscription price of the right issue. 20 lakh, the amount to be raised through the right issue divided by the number of right shares. So this is 5 lakh shares, this portion. So subscription price is coming to rupees 4. So how the value of right is calculated is equal to X right price minus the subscription price. So X right price is 10. We have already calculated this 10 minus subscription price. We also calculated subscription price 10 minus 4. So 10 minus 4 is equal to 6. So rupees 6, this amount is basically the value of right in the first case where one right share is issued for two existing shares. Now come to the second part. In the second part, what is it is saying in the question? The firm offers one right share for every 4 share held. So this is one right share for 4 shares. One right share for 4 share heads. So total right shares will be, existing shares 10 lakh. So 10 divided by 4, it will be 2,50,000 shares. Total right shares is 2,50,000 shares. Subscription price of right, what will be the subscription price? Total amount to be raised 20 lakh rupees divided by 2,50,000. Let us calculate it. 20 lakh upon 2,50,000 is coming to 8. Subscription price. Now calculate the X right price. X right price, the total capital before the right issue, after the right issue. So it will be 1 crore 30 lakh plus 20 lakh, same amount, total capital. This is the existing capital, and this 20 lakh is the capital after right issue. And denominator is the total number of shares, existing shares 10 lakh. And now for the right issue, the shares are 2,50,000. So it will be 1 crore 50 lakh divided by 12,50,000. Let us calculate it. It's coming to 12. Is coming to 12. Now we will calculate the value. Same procedure as in the case of 1. So value of right, is equal to X right price minus subscription price. How it is calculated? This here. X right price minus subscription price. So what is the X right price? It is 12. We have just calculated. And the subscription price we have also calculated. This is the X right price and this is the subscription price. So 12 minus 8 is equal to rupees 4. So rupees 4 is the value of right. Four is the value of right. So I hope it is clear to how this valuation of equity shares is done. We will take the last portion. Two portion we have already considered, and last portion is how does the shareholders' wealth change from 1 to 2, and how does right issue increase shareholders' wealth? We will see that in both the situation, that is when the company offers one right shares for two shares held or one right shares for four existing equity shares, in either of the situation, or before that, before the right issue, both in these three situations, whether there is any change in the wealth of the shareholders. Let us see. Now come to the third portion, effect on the wealth of the shareholders. Effect on the wealth of shareholders. Now, let us suppose that the shareholder invests in two shares. Suppose investor invests in 100 shares. Let us suppose. You can calculate with one share also, but let us suppose it is invest in 100 shares. Take the first situation. One right share for two shares. One right for two existing shares. Okay. Now let us take the first situation. And what is the effect on the wealth? Total value after right issue. So total value after right issue, it will be, if the investor is holding 100 shares, then after the right issue, what will be the total number of shares? The total number of shares will be 150. Means previously it was 100, and because of one right share is issued for 2 years, the two existing equity shares, therefore for 100 shares, 50 shares will be issued. So now his total shares will be 100 plus 50, 150. So it will be total value after right issue. It will be 150 shares, 150 shares multiplied by the X right price, that is value after the right issue. What is the X right price? X right price, see here it is rupees 10. So we multiply the 150 into rupees 10. It will come to 1500. Then from 1500, we will deduct whatever you can say expenditure has been made by the investor through the right issue. So whatever purchase price is borne, purchase acquisition price is borne by the investor should be deducted. So less right shares purchased, less the right shares purchased, number of right shares 50, because for 100 existing shares, 50 shares have been issued to him. So 50 shares multiplied by the, and how much, what is the right price of the right shares, right issue? In case of situation 1, subscription price of right, here, subscription price of right, it is rupees 4. So we will multiply 50 shares into rupees 4. So it will come to 50 into 4, 200. So it will be 1300. That is the value, that is the wealth, effect on the wealth of the shareholder. The shareholders has got the 1000 rupees, 1300 in the first situation. Now let us see what is the effect in situation 2 on the wealth of the equity shareholder after the right issue. Same way, one right issue for 4 existing shares. So total value, we are considering the situation 2. So total value will be, how many shares will be there? 100 shares. We are supposing that the investor is holding 100 shares. So one right shares is issued for 4 existing shares. So 100 upon 4, it will be 25. So so total shares will be 100 plus 25, it will be 125. So 125 shares multiplied by the ex-right price. See, situation 2. The ex-right price is this, rupees 12. So it will be, let us calculate 125 into 12 is coming to 1500. Is coming to 1500. From this, we will deduct the amount of this right shares purchased, which is actually 25 right shares are there. 25 right shares into rupees. What is the subscription price of right in situation 2? Subscription price is here. Subscription price of right, it is rupees 8. So we will multiply 25 into 8. 25 into 8, it is 200. It is coming to 1300. So we see that in both this situation, whether situation 1, when one right share is issued for two existing equity shares, or one right share is issued for four existing equity shares, the wealth on the shareholder is same, 1300. Now, if the right share could not have been issued at all, अगर right share issued नहीं हुआ होता तो क्या situation होता? Let us see. So value of shares before right issue. Before right issue, it is 100 shares. We are assuming that 100 shares are held by the investors. 100 shares into rupees. What is the existing price? It is given in the question. It is rupees 13. It is rupees 13. So 100 into 13, rupees 13, it is 1300 rupees. So we see that in all this situation, whether one right share is issued for two existing equity shares, or one right share is issued for four existing equity shares, or if right shares are not issued at all, the wealth on the shareholders is will remain the same. So there is no change in wealth. There is no change in wealth of the shareholders. Zoom a bit. I think this. I think your question you are asking. Zoom it further. I will just increase the font. I think it is now more clearly visible. The question. Okay. Fine. Why not divided by existing number of shares? Shares and subscription price. Existing number of shares. Shruti, subscription price. This is basically the subscription price of the right issue. Therefore, the total number of right shares are only considered. The subscription price of right issue only. If you see the formula, this is the subscription price of the right issue. This amount, whatever amount has been raised, the total amount this raise is 20 lakh. Huh? Therefore, this is here. This 5 lakh. If you, I think you are this pointing out on this point, subscription, that is the number of shares, the 5 lakh shares. It is basically the shares, right shares issued, 5 lakh shares. So subscription price of the right issue. Therefore, the number of right shares are only taken, not the existing equity shares. I hope now it is clear to you. No, wealth remains the same. Wealth is not decreased. Actually, it is the net wealth is calculated. Total value is calculated, and from that, whatever amount is paid by the investor for the right shares is deducted. Here you see, here it is the total value. This is the total value after the right issue. That is what is the total number of shares? 100 shares investor is already holding. Now he got 50 additional shares, and it is multiplied by the what is the current value? This is the subscription price. That is the 10 rupees in this case. So multiplied it by rupees 10, it is 1500. And from this, it deducted the right shares purchase, whatever amount it has been expenditure is made through right purchase. 50 shares it got from the company, and from 50 shares it has to pay at the rate of rupees 4, which I have already calculated. So 200 rupees it has to pay. This he already, this portion he already got because he is the existing shareholder. 100 shares is already got, 50 shares is already got, additionally got through the right issue. So this is the, you can say, his market value, and from that, this portion, whatever amount he has expenditure he's made towards purchase has been deducted. So this is actually the wealth, that is the net wealth. You can consider it as net wealth. And this change in net wealth, and there is no change in the net wealth in all these situations, situation 1, 2, and 3. Means whether the right shares are issued, one right share is issued for 2 existing shares, or one right shares is issued for 4 existing shares, or even if the right shares could not have been issued, would not have been issued, the situation will be same. Subscription price, see, subscription price is the price at which the right shares have been subscribed. Means whatever, this is actually the purchase price. You can say this is the purchase price. The that is the price which the shareholder, existing equity shareholder has to pay in order to acquire the right share. That this is the subscription price. But okay, so there is a difference between this value and the subscription price. Because subscription price in this case is the total amount which has been subscribed, and valuation is we will deduct this X right price, that is rupees 10, that is rupees 12 in this situation. In case of 2, it will be the 10, that is the X right price minus the subscription price. It is whatever the total, you can say the total price after the right issue and the subscription price. So net amount will be the value. So we are deducting the subscription price. So there is a difference, because value of right, it is a broader figure, and the subscription price is the narrower figure. Okay. So from X right price, the subscription price, whatever amount the investor has expended in order to acquire the right shares have been deducted. So after the deduction, whatever the net amount is, the value of the right, and subscription price only the purchase price of the right. So you can say it is a narrower vision, this narrower concept, this subscription price. Valuation of right is the more broader concept, because from this the X right price is subscription price is deducted from the X right price in order to arrive at the value. So this is the difference between these two. Okay. So shall I proceed further? For 100 share, it is 1,300. Wealth for 150 shares is also 1,300. So per share value is reduced for 100 shares. No, it is not the wealth. We are calculating 1,300 is not the value. It is the wealth. That is the net wealth we are calculating. Okay. So 1,300, what we have calculated is the net wealth. That is the total value, and we deduct the purchase price, whatever the investor has been, whatever expenditure the investor has been made while purchasing the shares. How I hope now it is clear to you the valuation of rights. Now come to valuation of redeemable preference shares. Please try to solve this problem at your home also, this assignment question. And even if any problem arises, you please write to us. The contact details I will be sharing at the end of this lecture. So don't worry. First, you try to solve this question at home also. Now, valuation of redeemable preference shares. There are two aspects to it: valuation of redeemable preference shares and the valuation of irredeemable preference shares. Valuation of redeemable preference shares is in this calculated in the same way. Concept is same as in the case of equity shares. It is similar in the sense that the dividend for every year, future dividend is discounted to arrive at the present rate. So this basically R is the discount rate. R is the discount rate. And since it is redeemable, that certain number of years maturity value will also be there. So maturity value is also discounted to arrive at the present value. Let us take a simple example. Let us say face value is rupees 10,000. Face value is rupees 10,000. Dividend is 12%, and it is redeemable after say 3 years. After 3 years, and discount rate is 15%. Okay. So let us solve this question. So this dividend 12% and the face value, see 12%, the face value, the dividend will be 1200, 12% of 10,000. So it will be 1200 divided by 1 plus 0.5, 1 plus 1200 upon 1 plus 0.5, it is 2 plus 1,200 plus 10,000 divided by 1 plus 0.5, 3. Now the redeemable value 10,000 is also taken. So let us solve this. So it is arrived at 1043, and this value, second value will be 907.37, and plus this 7364.18. So it is coming to 9315.03. Okay. So this is the value in case of valuation of Redeemable preference share, very simple formula. Now come to irredeemable preference shares. If we put the same formula and take the same figures, dividend is 1,200. Upon required rate of return, it is 0.15. So it will be 1,200 divided by 0.15 is coming to 8,000. So this is what is the valuation of redeemable preference shares and valuation of irredeemable preference shares. Any question? See, in this question, I will just urge you to solve this question at your home again. This wealth can be calculated from the this value itself. See, this total value 150 into 10, 1500 in the first situation. In the first situation, what was the situation? One right share for issued for existing two existing equity shares. So we are supposing that the investor is holding 100 shares. For 100 shares, he will be receiving 50 shares, right? So total shares now it will be 150. So 150 multiplied by 10, that is the you can say the X right price with theoretical X right price which we have calculated. So it is the total, you can say the total value now 1500. From 1500, whatever the investor has invested in purchasing the right shares should be deducted. So out of 50 right shares he has received. So from 50 right shares, at what price he has actually purchased the right shares? At rupees 4. So 50 shares multiplied by here. This 50 shares multiplied by rupees 4, it is coming to rupees 200. So 1500, which is the total value. From this, the purchase price 200 is calculated. So now its net wealth is actually calculated, because whatever amount is there from the purchase price only, the wealth can be calculated. So in this way, it has been calculated. Shruti, this in irredeemable preference shares. In irredeemable preference shares, the 1 plus R is not required. 1 plus R is generally, it is followed when this is the discount rate for every year. This is the discount rate for first year. This is the discount rate for second year. And in this question, we have taken it for third year. So this will be the discount rate for third year. Okay. Irredeemable preference shares, which we are actually assuming that it will continue for a long period of time, will continue till perpetuity. That is why it is 1 plus R is not taken. It is only the value of this discount rate is taken. See, just recall that in case of valuation of equity shares in Gordon's model, we written that here D1 formula is D1 upon KE minus G. Okay, fine. So here in this case, if growth rate is not there, then only it will be D1 upon KE only. If we assume that zero growth rate, in case of zero growth rate, the formula was D1 upon KE. Similar is the formula, dividend upon required rate of return. This is the dividend, and this is the actually the discount rate. So in case of redeemable preference share, there is no growth rate. That is why we simply divide the 1,200, that is the dividend amount, by the discount rate, which is 15%. Okay. I hope it is not clear to you. Okay. So this session PPTs of this are over. All the concept I have cleared to you in this valuation of equity shares. One question from the assignment in case of right issue I have already taken. Let us take rest of the question. And by solving this question, your concept will be more clear. So come to the assignment now. Okay. Now read the first question very carefully. Company has a book value of shares 137.89. Just read this question. Now, here in the question, the book value per share is given. So this book value is nothing but it is also known as equity or net worth. So book value is also called as equity and net worth also. Return on equity is given and company is retaining 60% of its earnings. Opportunity cost of capital discount rate is given, which is 18%. So what is the share price of today using both dividend growth model and the Walters model? The price of today means in this case you have to basically calculate the P0. Okay. Now let us solve this question. Answer 1. If you observe, so in this question, nothing has been given. So in where nothing has been given, then up to what period the investor is holding his shares, we can assume that the dividend growth rate will be continuous. Investor will be likely to hold this a company for you can say a long time, and growth rate will be indefinite because holding period is not given. So D1 upon KE minus G formula will be used. So P0 is equal to D0 into 1 plus G upon KE minus G, or it is also written as D1 upon KE minus G. Now, just look at the question whether the D0 is given, D0 is not given, and this you can say in this particular question, the growth rate is also not mentioned in this question. The growth rate is also not mentioned. But book value is given. So book value is the equity and return on equity is also given. So it will be the company's EPS. So it will be the company's EPS, earning per share. Because whatever equity is there, that has been must have been invested in profitable growth opportunity, whatever return is uh, the company has got is basically is EPS. So EPS will be 137.8, which is book value into return of equity into 15%. So it will be 137.8 into 15%, which is equal to is 20.67. And from that, dividend can also be calculated. If you see in the question, it is given that a company is following a policy of retaining 60% of its own earnings. It means the company is withholding 40%, company is declaring dividend at 40%. So it will be EPS 20.67 multiplied by the dividend rate, that is 40% distribution, 20.67 into 40%, it will be 8.27. So D0 has come. But the growth rate is also not given. So growth rate, the formula I have given growth rate, which I have discussed in my lecture also, that G or growth rate is also calculated by this way, B into R. What is B into R? It is basically the retention ratio multiplied by required return on equity. That is the required return on equity. Or you can say simply, I will write it as equity, return on equity. So, retention ratio, what is the retention ratio? Company follows a policy given in the question. Company follows a policy of retaining 60% of its earning. So, it will be retention ratio 60%. And return on equity, it is given to you 15%. So, 0.15. Let us calculate it. It's 0.09, or you can say it is 9%. Now put the figures into the formula. P0, D0 we have got 8.27 multiplied by 1 plus growth rate, that is 0.09 upon K minus G. So let us calculate it. It is basically coming to 100.16. Basically coming to 100.16. Alternatively, G should be either growth rate can be multiplied, or alternatively it can also be taken as P0 is equal to 8.27 without multiplying the growth rate. It can be assumed as D1 also, that is dividend at the end of the first year. So even without multiplying this growth rate also, it can also be calculated as this way. So in this case, your answer will come to 91 point. Answer will come to 91.89. So either way, it can be calculated. So now come to the Walters model. So Walters model, the first of all, this is, let us write the formula. P0 is equal to D plus E minus D R upon KE upon KE. So put the values into the formula. D 8.27 plus earnings we have already calculated. EPS is 8.27, sorry, 20.67, 20.67 minus 8.27 into R upon KE. R is multiplied by 0.15 divided by 0.18 divided by 0.18. So this is the Walters formula. Let us calculate it. So answer is coming to 103.33. So 103.33. I hope you all are getting the same answers in this assignment number 1. So assignment number 1, how we have proceeded. In this question, the question number 1, the book value per share is given and return on equity is given. So the formula is D1 upon KE minus G. But in this case, D1 is not given and growth rate is not given. So we calculate, first of all, we calculate the EPS. We calculate EPS from the book value per share. Book value is nothing but equity also. So equity per share is given, return on equity is given. So return on equity will basically you can see EPS, earning per share. From earning per share, we see that the company is retaining 60% of its earning. So it is declaring at the rate of 40%. So from EPS here, we calculated the dividend amount at the rate of 40%. So dividend is arrived 8.27. Now we calculate the growth rate also. Growth rate is also calculated by with the formula retention ratio into return on equity, because whatever the company is retaining and investing in profitable growth opportunity, and the return it is generated is basically the growth. So growth rate is we multiplied the retention ratio into return on equity. Retention ratio 60%. It is given in the question itself. This company is retaining 60%. So there is 60%, and this return on equity is basically 15%. So this 60% multiplied by the 15%, it will be 9%. So now we got the figures of D0, present dividend, as well as the, you can say, growth rate. So next we calculate the present value. See, we put the figures into the formula, and the answer we got is 100.16. Alternatively, it can also be calculated by this way without, you can say, multiplying it with the growth rate. So in the second situation, we have assumed that it is actually the, you can say, this dividend 8.27. We assume that it is the dividend at the end of year one. And in this case, the first situation, we assume that it is dividend, it is current dividend, or it is the present dividend. Okay, so whatever you calculate, if it is not specifically given in the question, you can put a note that it has been assumed as current dividend, or it has been assumed as dividend at the end of the year one. But if it is specifically given in the question that it is a present dividend, then you have to take it as D0. And if it is specifically given in the question that it is dividend at the end of year one, then you can directly take it as D1. Otherwise, you can put a note and solve the question accordingly. In water model, it is simple. So any question or no, this Shruti, this is KE is KE or R upon KE. This R 15% R required rate of return. If you see the question, see required rate on equity is 15%. Okay. And this opportunity cost of capital, the opportunity cost of capital, this is basically the KE. This is the discount rate. Okay. Now, come to the second question of our assignment. Based on the following information, current dividend is given in front of you, discount rate is given, growth rate is given. You will have to calculate the present value of ABC Limited. Now, in this question number 2, if you observe that nothing is specifically mentioned that up to what period the investor is holding this, wants to hold a share of a company. Holding period is not given. So it can be safely assumed that the dividend will grow at this 2% till infinity, till perpetuity. So D1 upon KE minus G formula will be simply used. So let us calculate it. Question number 2. Just give me a second. Okay, now. So basically P0 is equal to D0 into 1 plus G upon KE minus G is equal to P0 is equal to D0. D0 is given in the question, current dividend 2.5. We multiplied 1 plus G. The growth rate, it is 2%, 0.02, divided by KE. Discount rate is also given, 10.5. So 0.105 minus growth rate, that is 0.02. Let us calculate this. It's coming to, just check it, it is coming to rupees 30 in this case. It's coming to rupees 30. Yes, it is 30. Correct. First, okay, just give the question. 18%. First part, 18%. Just give me a second. Okay, just give me a second. Okay. Uh, my apologies. It is actually, it will be, I think this confusion is creating to you. It is actually 18%, 0.09. 18% will be the discount rate. So, thank you for pointing it out. As it has been inadvertently written, that is, it is actually the 0.8, 18%. 18% will be the discount rate. So this discount rate is will be taken in both these cases. Discount rate will not be different. So in both the Gordon's model and the Walters model, 0.8, that 1.8, that is 18% is the discount rate in this question. Okay. Now come to answer 2. I'm solving this question number 2. Okay, fine. Now come to the second part of this question. What it is asking is that it is asking for if is the stock overvalued if stock price is 35. Return on equity is 9% and EPS is equal to 2.25. Show detailed calculation by price earning multiple approach and the earning growth approach. The price earning multiple approach, first we'll take the price earning multiple. So in this case, the P0 is equal to price earning multiple into EPS. In the question, the EPS is given to you. In this question, the EPS is given to you. Price earning ratio is not given to you. So the price earning ratio can also be calculated as 1 upon ROE or return on equity. That will be 1 upon ROE is taken as 9%. So 1 upon 0.09, it will be upon 0.09. So it will be 11.11. 11.11. So it will be P 11.11 into EPS. EPS is already given 2.25. So 11.11 multiplied by 2.25, it is actually coming to 25. So this is the P0 in case of 25. So we can say, is the stock overvalued in this case? We compare it with the current market price. The current market price is 35. And in this case, the P approach, the P0 is coming to 25. So what is this P0? P0 is also, it is called the intrinsic value. So as we have discussed during our lecture also, that if intrinsic value is less than, if the intrinsic value is less than the current market price per share, the answer will, it can be considered that the company is actually overvalued. The company is overvalued. So the decision will be to sell, or if you have already invested, willing to invest in such company, to avoid. And conversely, when intrinsic value is greater than the market price per share, it is considered as undervalued. And decision will be to buy in case of such situations. So in this case, intrinsic value is less than the market price. What is the reason behind it? You may ask, what is the reason behind it? The reason behind it is that intrinsic value is the price. It signifies the future price. I mean, it is the price at which it will be available in the future. So chances are that in future, the price will be hovering around rupees 25. But the current market price is 35. So we, as an investor, I as an investor, purchase the shares at 35, and the chances are that share will decrease to 25 in the future. Why should I purchase it? What should I buy it? So the answer will be to, if I am holding it, to sell the shares or just to avoid investing in this company. So that is what is the relationship between the intrinsic value and the market price per share. Now come to the second approach, the earning growth model. So we will calculate the P0 in this earning based model. P0 is equal to EPS 1 plus growth rate upon T minus G. EPS is given in the question 2.25. EPS is given in the question, and uh, growth rate is given. Rate is given 2%, 0.02 multiplied by KE minus G. KE minus G. Discount rate is 0.09. 0.09 minus growth rate, that is 0.02. Student, in this case, this confusion may arise that why this 0.9% discount rate is used and not the discount rate, that is the 10.5% is used. The reason is that in earning growth model, return on equity and we can say the discount rate is used interchangeably, because what is the basic purpose of the earning growth model? In earning growth model, the focus of the company is on the retention, because in case of those companies, there are profitable growth opportunities. Since there are profitable growth opportunities, such companies want to retain the profits and invest in such profitable growth opportunities. It wants to declare less dividend or no dividend at all. So in such situations, the cost of equity means those portions, the retained earning portions, the reserves and surplus portions, are already invested in those investment opportunities. So whatever return is there is actually the return on equity. So in such situation, as the company is not declaring dividend, this return on equity and the discount rate can be used interchangeably. So in such cases, the discount rate can be taken as the, you can say, return on equity. The return on equity can be taken as the discount rate in case of only earning based model, not dividend based model. In case of dividend based model, this will be the discount rate. So in first situation, I have taken 10.5% of the discount rate, but in the second situation, I have taken the 9% as the discount rate. In this case also, I have taken 1 upon our return on equity. This is similar to KE also, cost of equity, or you can say return on equity has been used interchangeably here. Because if you follow the dividend based model, it will be 1 upon KE, and earning based model, since P multiple is a part of earning based model, it is taken as 1 upon RO, 1 upon ROE, that is return on equity. Now let us solve this question. 2.295 divided by 32.79. The answer is coming 32.79 as per earning based model. Now this, whether this 32.79 at this 32.79 intrinsic value, whether the investor should invest, what is the current market price? The current market price is more than the intrinsic value. So if the, in this case, the intrinsic value again is less than the market price. What is the intrinsic value? Intrinsic value is 32 point, it is 32.79, which is actually 32.79, which is actually less than the current market price. So since it is less than the current market price, the decision will be to sell or not to invest in the company. The decision will be to sell, or if it has already holding it, or if it has not purchased, then not to invest or avoid investing in the share of such company. Okay. Okay, fine. So, how this has been calculated? First of all, we calculated with the help of the dividend discount model. The first portion, since all the figures are given, we have taken it as the dividend distribution is actually will be continued till perpetuity. Second aspect, we calculated with the help of the price earning model approach. As per the price earning, we have taken, in this case, price earning ratio is not given. So price earning ratio is calculated with the help of 1 upon return on equity. And from by putting the figures into the formula, we have calculated rupees 25 as the P0. This 25 P0 is less than the current market price per share. Therefore, we can conclude that the company is overvalued and it is time to sell. In the second portion, earning based model, we have also calculated the P0 with the help of EPS. And in this situation, also the intrinsic value or the present value, that is 32.79, in this case is actually less than the market price, which is given into the question, which is 35. So since intrinsic value is less than the current market price, the answer will be to sell. So in this case, I will be taking a brief break of about 10 to 15 minutes. Just come back after the break and we will continue with the other assignment questions. Thank you. अशोक जी ब्रेक दे दीजिए. Yes, welcome back. Now come to the question number 3 of your assignment. Just read this question carefully and then we will proceed. MNP Limited has declared and paid annual dividend of 4 per share. It is expected to grow at the rate 20% for the next 2 years and 10% thereafter. If you see that this is a question on two-stage discount model, because firstly it is given that it is expected to grow at 20% for next 2 years. That is exponential growth. And 10% thereafter means till perpetuity. So it is the second stage of dividend discount model will be followed. So let us solve this question. Okay. What is the present value factor? Discount rate is 15%. The rate 15%. And this is PV, that is the present value. Okay. So end of the year, 1, 2. For 2 years, na? 2 years it will be exponential growth rate. So first we will find the present value for first 2 years. I have taken example also. You can recall that. First of all, we will calculate the present value for the exponential growth rate. That is 20% for 2 years. So it will be current. What is the current dividend? It is current dividend is 4. So it will be 4 multiplied by that is what is the growth rate? The growth rate is 20%. So 4 into 1.2. So 4 into 1.2. Let us calculate this. $4.8, and then dividend of the end of the first year 4.8 is multiplied with the growth rate again in order to calculate the dividend at the end of the second year. So 4.8 into 1.2 is 5.76. Now we apply the present value factor discount rate to arrive at the present value. Discount rate, it is given in the question itself. Year 1, 0.8696, 0.8696, and year 2, 0.7561. Let us calculate this, and it is basically coming to 4.17 and 4.36. So let us add these two figures. 4.17 plus 4.36 is coming to 8.53. So this is the present value at 20% growth rate. Now, again, go back to the question. It is telling that after 2 years, the growth rate, dividend growth rate will be 10%. And 10% thereafter means it will be followed till perpetuity, continuity, indefinitely. So dividends Gordon growth model T1 upon KE minus G formula will be used. But in this case, here P2 will be there. P2 is equal to D2 into 1 plus G upon KE minus G, or it can also be written as D3 upon KE minus G. Why P2? P2 because it is the start of the period for a normal growth rate. It is also called the terminal value. It is also called terminal value. Terminal value means the value is the start of a normal growth rate period, or you can say that it is the end of a supernatural or exponential growth rate period. And we signified as P2 because now we are calculating present value at the end of the second year. For first 2 years, we have already calculated. Now it is the present value at the end of the second year or from the start of the third year. So let us put the figures into the formula. Dividend of second year D2 we have already calculated 4.8. Pardon, it is 5.76. Is 5.76 multiplied by 1 plus 0.10. So now the growth rate is here. The growth rate is 10%. The growth rate is 10% now. So 0.1 upon K minus G, that is discount rate is 0.15 minus G 0.10. Let us calculate this. It's coming to 6336 divided by 0.05. Let us calculate this. 6.336 divided by 0.05. 126.72. So this is basically P2 or present value at the end of the second year or at the beginning of the third year. But we have to calculate present value now, P0. So this P0, now calculate P0 at 10% growth rate. 10% growth rate. So it will be 126 present value at the end of second year multiplied by the present value factor of the second year. This. So multiplied by 0.7561. So 126.72 multiplied by 0.7561, it will come to 95.81. It will come to 95.81. So now P0 at both 20% growth rate and 10% growth rate is equal to, we will multiply, add both this figure, P0 at 20% growth rate and this figure, P0 at 10% growth rate. We will add both these figures. So it will be 8.53 plus 95.81. So it will be coming to 104.34. 104.34. So this is the present answer which is coming, 104.34. Manjuta is asking that in second stage it is from third year. So why second year discount rate is considered? See, as I have just explained that the amount, this portion P2, it is the beginning of the third year, or it is the end of the second year or the beginning of the third year. That is why, and this discount rate is considered discounted at the end of the third year itself, because discounted the end to arrive at the present value. So the discount rate for the second year will be considered because it is the value at the end of the second year only. We are arriving at the end of the second year or at the beginning of the third year. They one and the same thing. Okay, I hope it is clear to you now. Any question in this? Otherwise, I will proceed it further. This is the second stage discount, and we have discussed during the course of lecture also. I have taken a brief example and this assignment question also. So how we have proceeded? We first of all calculated the present value at 20%, which is the exponential growth rate. This portion to calculate the present value, and then we arrive at the present value at the end of the second year or the beginning of the third year, which is called P2. It is also called the terminal value. What is terminal value? Terminal value is the value at the which at the value at the beginning of the normal growth rate period, which is 10%, or it is the end of the super normal growth period or exponential growth rate period, which is 20%. So we are first of all we arrived at the present value at the end of the third year, which is 126.72 present value at the end of the third year. But we have to calculate the present value now, P0. So in order to calculate P0, we multiplied 1672 by the discount factor of this second year, 0.7561. So this value, this 95.81 is the present value at 10% growth rate, and this is the present value at 8.53 is the present value at 20% growth rate. We add both these figures to arrive at 104.34, which is the present value at both 20% and 10% discount rate. Okay, now come to the next question. Question number 4. Now, please go through this question carefully. I hope this is visible to you, more clearly visible to you. Okay. What this says, that X Limited just declared a dividend. So it is a current dividend, the present dividend of 14 per share. Now it is say that Mr. B, an investor, want to purchase the shares of X Limited. Okay. And it is anticipating that growth rate will be 9% and it will continue for the next 3 years. So for 9% growth rate for next 3 years. Then the last sentence says that he also expects the market price of this share to be 360. This is important. He expects the price of this share to be 360 after 3 years. It means that Mr. B wants to hold the share for 3 years. Holding period is 3 years. So the Gordon's formula, the Gordon's perpetuity assumption will not be considered. Why? Because in this case, the investor is holding it for 3 years. The Gordon's perpetuity assumption is followed, in which case this is assumed that the investor will hold the company share for a long time, till indefinitely, continuously. So D1 upon KE minus G formula will not be used here. So what is the point 1 says? The maximum amount Mr. B should pay for shares if he requires a rate of return of 13% per annum. So discount rate is 13%. Maximum amount Mr. B should pay. This maximum amount concept will be more clear to you after solving it. I will again explain it this portion, the maximum amount. Okay. Now let us solve this question first. Present value factor at the rate. What is the discount rate? It is 13% at the rate 13%, and last column present value. So for 3 years, 3 years it is holding. Here it is mentioned that in the question, it is for 3 years. The investor is holding it for 3 years. So year 1, year 2, year 3, and again. So in this case, the dividend will be discounted to arrive at the present value, and also the market price. In this case, the market price 360 will also be discounted to arrive at the present value, right? So current dividend, it is 14. Okay. So 14 multiplied by 1.09, the growth rate, it is given in the question. So 14 into 1.09, 15.26 is the dividend. What is this? 15.26, it is the dividend at the end of the year one. Because in the question, it is specifically given that 14 is the present dividend or the current dividend. Now, what is the dividend at the end of the second year? It will be dividend at the end of the first year multiplied by the growth rate, which is 9%. So 15.26 multiplied by 1.09 is coming to 16.63. Now again 16.63 dividend at the end of second year will be multiplied by the growth rate 9% to arrive at the dividend at the end of third year. So 16.63 multiplied by 1.09. So it will basically come to 18.13. 18.13. Now we will multiply it by the present value factor to arrive at the present value discount rate. So discount present value factor is given year 1 0.885, year 2 0.783, year 3 0.693. Okay, now let us multiply this. So 15.26 multiplied by 0.885 will come to 13.51, and 16.63 multiplied by the present value factor 0.783 come to 13.02, and this 16.63 into 18.13 into 0.693 is coming to 12.56. Again, the 360, this figure is also to be taken, considered. Market price at the end of third year. Present value of this figure is also required to be calculated. Those 360 multiplied by the present value factor of the third year. 360 multiplied by 0.693 is coming to 249.48. 249.48. Let us add all these figures. Is coming to 288.57. 288.57. So it is coming to 280. Now it is visible to you, I think, 288.57. So this is the first portion, P0. So we have arrived at the P0. P0 is equal to this. We hold it 288.57. Okay, fine. I think it is more or less simple. Now come to the second point. The maximum price. Now come to this maximum amount. I am telling that I will explain it to you. The maximum amount Mr. B should pay for shares. The maximum amount is basically this intrinsic value. Intrinsic value or the present value, which is denoted by P0. Fine. So what is this intrinsic value? Intrinsic value is the present value of all future cash inflows in the form of dividend or earning, whatever it is discounted to arrive at the present value. This is intrinsic value. So intrinsic value signifies that in future, the share price will increase up to that amount. The share prices will increase up to that amount. Means will reach that amount, you can say. So this 288.56 signifies that in some future time, it will reach, share prices will reach 288.57. And it is very unlikely that the share will move beyond or move above this 288.57. So if the current market price right now is less than this 288.57, then it is actually fruitful to purchase it. So what is the maximum amount? This is the maximum amount, because this is the maximum amount at which investor would be likely to purchase, because chances are that the market price of the share will not move beyond this 280. 57. So the investor will take out from its pocket the maximum amount of 288.57 because it is likely that the share prices may not most likely may not move above this present value 288.57. Okay, so that is why the term maximum amount is given here. Now come to the second point, that what is the maximum price Mr. B will be willing to share if he is of the opinion that 9% growth rate can be maintained indefinitely and requires a return of 13% rate of return. So what you observe in this part second, the growth, 9% growth rate can be maintained indefinitely. This is important. Indefinitely. It means the growth, 9% growth rate will continue for a long time to come, indefinitely, perpetually. So the Gordon's formula will be used in this case. That is D1 upon K minus G. So let us calculate this. So P0 is equal to D0 into 1 plus G upon K minus G. Or it can also be written as D1 upon K minus G. So what is the D0? D0 is given in the question. It is 14. Hmm. 14 into 1 plus, that is the growth rate, 0.09 upon KE minus G. Discount rate, it is given 13%, 0.13 minus G, 0.09 is equal to, we have already calculated this, 14 into 1.09, here 15.26, this amount, 15.26 divided by 30 minus 9.04. So let us calculate it. Is calculated coming to 381.50. Is 381.50 is coming. Fine. Now second answer is coming. It is very simple to understand because it is specifically given in the question that the growth rate is indefinitely. Simply the Gordon's formula, this perpetuity formula will be used. Now come to the third point. Third point, what it is asking in the question, the price of share at the end of 3 years, that if 9% growth rate is achieved and assuming other conditions remain same as in 2 above. Now, the first sentence, in this sentence, the first part is important. The price of share at the end of 3 years, this is important. At the end of 3 years, what this tries to say? It tries to, what is this? Can you tell? Price at the end of 3 years. End of 3 years means it will, or at the beginning of the 4th year. So it will be P3. It will be P3. So we have to calculate P3. Price at the end of 3 years, specifically given in the question. So P3 will be D3 1 plus G upon K minus G. Or it can also be written as D4 upon K, D4 upon K minus G. I hope it is clear to you. So let us solve this question. So P3 is equal to D3 into 1 plus G upon K minus G is equal to D3. It is already, I think we have calculated this D3 dividend at the end of 3rd year, 18.13. 18.13 multiplied by the discount rate 1 plus uh, discount rate, sorry, growth rate will be same, 9% growth rate. So 0.09 divided by KE. The discount rate is no change in the discount rate also, 13%. 0.13 minus growth rate. So let us calculate it. So it will be 19.76 divided by this 0.04. 19.76 divided by 0.04 is coming to about 494. So 494 is the answer. This is the value of P3. We will not calculate P0 of this amount because the question has been specifically asked that only we have to calculate the price at the end of the 3 years. So we will solve up to P3 only. I think all these three portions have been clear to you. Any question? So this question for number 4 is over. Now come to question number 5. No, this P3 can be discounted if it is further asked in the question that you have to calculate P0 also of this P3 amount. But here in the question, it is specifically asked that you have to calculate price at the end of 3 years. So we'll only calculate P3. We will not calculate P0 of this amount. Okay. So we will stick to what is asked in the question. Now come to question number 5. Okay. Now, this question number 5 is a very good question. See the question first of all and try to make out that which valuation method will be followed in this case. Whether dividend discount model will be followed, whether earning based model should be followed, or free cash flow method will be followed. Let us look through the question carefully. Profit of the company is given, equity share capital, par value, debt ratio, long run growth rate of the company is given. Now come to the last three items. That is, here the capital expenditure per share is given, depreciation per share is given, and change in working capital is given. And all these figures are given in on per share basis. If you observe, every figure is on per share basis. So you can easily make out from this that the free cash flow to equity method will be followed in this case, because capital expenditure, depreciation, change in working capital, all these are used in the free cash flow to equity method. Now here the profit of the company is given, the entire profit, but the figures are given here in per share basis. So we will calculate the profit on per share basis only, which is simply the EPS. Another thing which I have to take care of is the company debt equity ratio is 27%. So the equity portion is basically 73%. So we will stick to our calculation on this basis, 73% basis. And another thing which is to be followed, carefully observed in this question is that here the beta is given, risk-free rate is given, and market return is given. It means the cost of equity capital has to be calculated on the basis of the CAPM model. If you observe this question, the discount rate is not given. You have to calculate the discount rate, but not by the Gordon's method, by the CAPM model. Because from the figure you can make out beta is given, risk-free rate of interest is given, and market return is given. Now solve this question. After solving this question, you will be able to understand this question better. Now, First of all, we calculate the EPS because profit of the company is given here. Profit of the company is given 290. So rupees 290 crores. What is EPS? Net profit of the company, profit after tax divided by the number of equity shares. So whether number of equity share is given, the number of equity share is not given, we can calculate it with the help of this equity capital and the par value. So basically it will be 1,300 crore divided by rupees 40. So what will be come to? 1,300 divided by 40 is 32.5. 32.5 crores. So number of equity shares is 32.5 crores. 32.5 on 32.5. So 290 upon 32.5, it will come to 8.923. That is the EPS. So if you understood that, the first of all, EPS have to be calculated. Why? Because all these figures, capital expenditure, dividend, and working capital are given on per share basis. That is why the profit on has been calculated on per share basis also. Simply we calculate the EPS, profit after tax divided by the number of equity shares. So number of equity shares not given, we have calculated it 32.5 and we divide this profit figure by the number of equity shares. That is 8.923 is the EPS. Now, next we have to calculate the KE. KE is not given in the question and it has to be calculated as per the CAPM model. That is RF plus beta into RM minus RF. We have discussed it during our lecture also that RF is the risk-free rate. It is the beta. Beta shows the volatility. RM, it is the market rate of return. Now put the figures into the formula. Risk-free rate, it is given in the question. It is 8.7%. What is beta? Figure of beta is also given 0.1. 0.1. RM is 10.3%. So 10.3% minus RF 8.7%. So let us calculate this. So it is coming to 8.86, the CPS figure, this KE figure. So we have calculated EPS, we have calculated the discount rate. Now let us calculate P0. Before calculating P0, we will calculate free cash flow from equity. So FCFE or free cash flow to equity is equal to what was the formula? How to calculate it? No pad. That is net operating profit after tax plus depreciation minus any capital expenditure, okay, minus any net change in working capital. Now, non-operating profit after tax, we have calculated 8.923. All the figures are on per share basis. 8.923 plus. Now, here it is important to observe that here the debt ratio of the company is 27%. It means if 27% is debt, then 73% is equity. So all the figures have to be calculated on the basis of equity because we are now concentrating on the valuation of equity shares only. So every figure have to be proportionately multiplied with the calculated on the basis of equity, which is 73%. So it will be 0.73 multiplied by depreciation. How much is the depreciation? Depreciation is 39 minus capex again on the proportion of equity. 0.73 multiplied by capex, which is 47 minus Again, net working capital on the basis of equity 0.73 multiplied by change in working capital given 3.45 per share. Okay, let us calculate it first. So it will be 8.923 plus 28.47. Depreciation will be added. Then capex, it will be 47 into 0.73, 34.31 minus working capital 3.45 multiplied by 0.73. It is 2.5185. 2.51. So let us add all these figures, calculate it. It is coming to 0.5645. Let us check it is coming to 0.5645 or not. So FCFE is 0.5645. So from this FCFE, we will calculate the present value, P0. So P0 will be this FCFE, that is free cash flow to equity, multiplied by 1 plus growth rate upon KE minus G. So FCFE is, we have calculated 0.5645 multiplied by 1 plus growth rate. Growth rate is given 8%. So 0.08 divided by KE minus G. Discount rate, we have calculated discount rate. It is actually coming to 8.86. So 0.0886 minus growth rate 0.08. So let us calculate it. Point 60966 divided by 0.06. Now calculate the numerator. 0.0886 minus 0.08. 0.0086. Let us calculate it. It is coming to 70.89. It is coming to 70.89. 70.89. That is the present value. So this way we have solved this particular question. So how we have approached that? From the question, we can easily make out from this portion, that is the capital expenditure per share is given, depreciation, change in working capital, all these figures are given on per share basis. And from these figures also, we can easily say that the valuation of equity share in such cases can be solved by free cash flow to equity method. Since all the figures are given in per share basis, we have calculated profit on per share basis also. So first of all, we calculated the earning per share of the company here. And we further see that in the question, the cost of equity capital or the discount rate is not given. So we have to calculate the discount rate on the basis of whatever figure is given in the question. So beta is given, risk-free rate of interest is given, market return is given in the question. So from the whatever figure is given, we can easily deduce, we can easily tell that cost of capital in this case can be calculated with the help of CAPM model. So we simply apply this CAPM model, that is risk-free rate plus beta multiplied by market rate of return minus risk-free rate. So discount came to 8.86. 8.86. This figure, discount rate is 8.86. We calculated the EPS, we calculated the discount rate, then we proceed towards calculation of free cash flow to equity. Free cash flow to equity, simple formula used, net operating profit after tax plus depreciation minus capex minus change in working capital. Put the figures into the formula, we get the free cash flow to equity as 0.5645. Then this is only the free cash flow to free cash flow. We then calculate the present value of this free cash flow. So we put the figures into the formula and then we got the present value of as per the free cash flow to equity method, which is 70.89. I hope this question is clear to all of you. Now, we will proceed to the next question, which is question number 6. First of all, read this question carefully, and then we will proceed towards solving this question. Debenture is given, bond is given, equity shares are given, reserves and surplus given, total asset turnover. Okay. So, what is asking in the question? If you see that, first it is asked in the question is to calculate the income statement. So, for calculating income statement, is any figure is given in the question? From looking through the question, no absolute figure is given. To calculate income statement, we have to start from sales. Figure of sales is not given, but the sales can be calculated with the help of the asset turnover ratio, because total assets are given and asset turnover ratio is also given. So on this basis, the total sales can be calculated. Again, operating margin is given. So operating margin is 10% of the sales. So if operating margin can be calculated, cost of goods sold, cost of goods sold can also be calculated. So by this way, we will proceed. So let us first calculate the working notes and then we will draw the income statement also. First of all, let us do some working notes. Prepare some working notes. Okay. Asset turnover ratio is given. It is turnover or sales upon assets. And it is basically 1.1. So sales is 1.1 of assets, and assets are given the figure of asset. What it is actually 600 lakhs. So sales will be 600 multiplied by 1 into 1, which will be 600 into 1.1, which will be 660. Okay. If there is 660 sales, then operating margin is given. What it is? 10%. So operating margin will be 10% of 660. 660 into 10%. So it will be 66. If operating margin is 66, then what will be COGS? That is cost of goods sold. It will be sales minus operating margin. So it will be 660 sales minus operating margin. So 594 will be the COGS, that is cost of goods sold. Fine. So from this basis, can we prepare the income statement? The answer is yes. Let us prepare the income statement. First of all, rupees sales. What is the sales? We have calculated 660 less COGS, cost of goods sold. We have calculated 594 Then what we'll arrive at is operating margin. Operating margin. So it is 66. From this will be deduct interest. From operating profit, operating margin will be deduct interest. Again, while calculating interest, you have to be careful and watch the question, or you can say observe or read the question carefully. See, in this case, it is written effective rate of interest. If you have the effective rate of interest, which is, sorry, effective rate of interest, which is 8%. Effective rate of interest is 8%. So, we will calculate interest on this amount, that is debentures and bonds. The amount is 125 plus 50, 179. 175. Total debt is 175. So interest will be calculated at the rate of 8% on this 175. And interest will not be calculated separately at 8% and 10%. Okay, I will repeat that if effective interest rate is given in the question, the effective rate of effective interest rate will be applied to calculate the interest. If this effective interest rate would not have been given in the question, this effective interest rate, then you have to calculate interest separately, means 8% on debentures and 10% of it. But since this effective interest rate is given, you have to calculate the interest at the rate of 8% only. On what amount? On this amount, 175. Debentures plus bond. I hope it is clear to you. Now calculate the interest. This is 175 into 8%. 14. The interest is 14. 175 into 8%. Now 66 minus 14, it is 52. It is actually rupees in lakhs, these figures. So what is 52? 52 is EBT, earning before tax. From this, we deduct the tax amount. How much is the tax? Let us see in the question. Tax rate. Tax rate is 40%. So tax at the rate of 40%. 52 into tax 40%. 20.8. So tax is 20.8. Let us deduct this figure. 52 point. Let us deduct this figure. This is coming to 31.20. So it will be actually profit after tax. This is profit after tax. From this, we will deduct dividend paid. While calculating dividend paid, again, important information is given in the question. Let us see regarding dividend. It is given that dividend payout ratio is 16.67. Dividend payout ratio is 16.67%. So what it means? It means retention is 83.33% retention. But dividend is 16.67%. So we have to calculate dividend paid at the rate of 16.67%. So we'll calculate 13.12 into 16.67%. Is 5.20. So rest of the amount after deducting the dividend from the profit, the remaining amount will be retained earnings. Second part of the question, what it is asking about the sustainable growth rate. Now, this growth rate can be calculated also with the help of the formula retention ratio into return on equity. Retention ratio into return on equity. So what is the retention ratio? Retention ratio 83.33 because 16.67% the company is paying dividend. So if 16.67% the company is paying dividend, then the retention ratio will be 100 minus 16.67%. It will be 83.33%. So 83.33% the company is retaining as retained earnings. So retention ratio, it is 0.83.33%, that is 0.83333 into return on equity. Whether it is given in the question, let us see. Required rate of investor, the discount rate is given, but return on equity, if you see the question, return of equity is not given. So you have to calculate the return on equity. So ROE, return on equity, is equal to, what is the form, how it is calculated? Profit after tax upon equity. Profit after tax upon equity. Profit after tax, it is given in the question, or we have calculated it. Profit after tax is 31.20. 31.20 upon equity. What is equity? Let us see. Equity is this portion. Equity share capital plus reserves and surplus, or this 100 plus 300. This is actually equity. Equity portion. So 100 plus 300, it is 400. 400 is the equity. So let us calculate the return on equity. 31.20 divided by 400 is to 0.078. 0.078 or 7.8%. That is coming to 7.8% return on equity. So now calculate the growth rate, 0.833 into return on equity, that is 0.078. Multiply this figure. It is coming to right now. Now come to the third part of the question. First part of the question is over. Second part is over. Come to the third part of the question. It is saying that calculate the fair price of the company share using dividend discount model. So fair price is the true value, or you can say it is the P0. So basically you have to calculate calculate the P0 or the intrinsic value in this case using dividend discount model. So in this case, nothing is given. So you can safely assume that the Gordon's formula perpetuity, that the dividend growth rate will continue till infinity or indefinitely will be followed. So D1 upon KE minus G formula will be used. So fair value or P0 is equal to D0 into 1 plus G upon K minus G is equal to, put the figures into the formula. G dividend we have already calculated. Dividend per share is not given, so dividend per share have to be calculated, students. This is 5.2 is given dividend paid. So 5.2, this is figures are in rupees in lakhs. So 5.2 is 5,20,000. So D0 will be, it is the total figure, 5,20,000 divided by what is the number of equity shares? Let us find out. This is the equity share capital is 100 lakh and price of one equity share is rupees 10. So 100 divided by 10, it will be 10 lakh. So number of equity shares will be 10 lakh. So let us calculate it. 5,20,000 divided by 10 lakh is coming to 0.52. So D0 is 0.52. So apply this figure. 0.52 is D0 plus 1 plus growth rate. Growth rate we have calculated. A 7 growth rate we have calculated 6.5%, 0.065. Discount rate is given in the question. Discount rate, I think it is given in the question, 15%. Minus G, 0.065. So let us calculate it. 0.52 multiplied by 0.065 upon 0.5538, 0.5538 divided by 0.15 minus, just solve the denominator, 0.15 minus 0.065 is 0.085. So it is generally coming to 6.52. Just check once again. 0.5538 divided by 0.085. It is coming to 6.52. Coming to 6.52. So this is the fair value. So third portion is completed. Now come to the fourth portion. No, fourth portion, what it is saying? It is saying that what is your opinion on the company's investment in the company share? It is saying that what is your opinion on investment in the company share at current price? But the current price is given. Yes, the current price is given here. This current price is given. That is rupees 14. So intrinsic value is current price is 14. So current market price is 14. And intrinsic value, what is the intrinsic value? Intrinsic value is 6.52. So this current market price is actually greater than this intrinsic value, which is 6.52. So you can say the company is overvalued. The company is overvalued and it is to sell or avoid investing in the company. So as we have said that this intrinsic value 6.52 is the maximum value at which the investor can invest. Why? Because there is every chance that the price will reach to 6.52 in the future. At present, the current market price is 14. It means it is overvalued. If we now purchase at 14, it will most likely the share price will fall down to 6.52. Then there will be a loss for the investor. So the decision of the investor will be to sell because it is overvalued. Or if he hasn't invested in the shares of a company, it is better to avoid. So this is what the question is. Any question? As otherwise, I will proceed further. Okay. Now come to question number 7. Solution to question number 7. Now read this question carefully. Mr. A is thinking of buying shares at 500 each and face value is rupees 100. Okay. And he's also expecting a bonus share 1:5 in the fourth year. Expected dividend is 20% and it is to be maintained 20% every year. The company will pay dividend at 20% every year. So this is a constant growth rate model. He intends to sell the shares at the end of seventh year at an expected price of 900 each. Students, this is very important. Just read this carefully. He intends that Mr. A intends to sell the shares at the end of seventh year at an expected price of 900 each. So he wants to hold the share for 7 years. So in this case, again, the dividend discount model of Gordon's, that is the dividend will grow at certain percentage till infinity will not be applied. Or D1 upon KE minus G formula will not be applied here. We have to calculate the present value for each year separately. Means dividend of first year, then we will discount it at the present value. Dividend of second year, then we will discount it at the present value. Dividend of third year, then we'll again discount it to arrive at the present value. So for each year and so on. So for up to seventh year, we have to calculate this separately. I hope you understand this. Let us solve this question in which your understanding will be more, I think, will be better. We'll solve it here because this is a. In the same way which you have calculated before, end of year, uh, dividend oblique price. This is present value factor. Discount rate, present value factor, discount rate, it is given in the question. I think here he expects a minimum return of 12%. Discount rate is given, it is 12% at the rate 12%. And lastly, present value. Okay. For 7 years separately, we have to calculate 1, 2, 3, 4, 5, 6, 7. Not only dividend, but also the price at the end of the seventh year will also be discounted to arrive at the present value. This price, 900, which will be receiving after the 7 years, also got to be discounted to arrive at the present value. So what is the dividend at the end of the first year? The dividend at the end of the first year, it is assumed that it will be 20% every year, fixed dividend. So dividend is calculated at face value, rupees 100. So this 20% of 100 will be dividend 20. So rupees 20 will be the dividend. So 20 for 3 years, it is 20. But again, just go through the question carefully that here it is important also. He is expecting a bonus at the ratio of 1.1:5 during the fourth year. Fourth year, there will be a bonus issue, 1:5. Means for every 5 shares, one bonus issue. So for one share, we are assuming it as calculating on the basis of one share only. For one share, there will be 0.12 share. Okay. For 5 share, one bonus share will be issued. So for one share, 0.2 shares will be issued. Again, if for one share, now the total share will be how much? Total share will be 1 plus 0.2, that is 1.2. Total share will be, after the issue of bonus shares, total share will be 1.21 plus 0.2. Here we have calculated. So for one share, the dividend is rupees 20. Fine. So for 1.2 share, what will be the amount of dividend? It will be 20 into 1.2, that is 24 rupees. So in fourth year, the dividend will be rupees 24. I hope this calculation is clear to you. Now for fifth year also, it will be 24. Sixth is 24. Seventh is also 24. Now we give the discount factor of all these years at the rate 12%. Let us write the discount factor for all this. It is first year 0.893, 0.797, 0.711, 0.636, 0.567, 0.045. Now let us multiply this dividend at the end of first year with the discount rate to arrive at the present value. Just give me a second. Now, 17.86 present value, 20 into 0.797, 0.94, 14.22, 15.264 or 15.26. For fifth year, it will be like this only, 13.61. Okay, for sixth year, it will be 12.17. For seventh year, it will be 10.85. Now, seventh year, the price, Mr. A will be selling the shares at rupees this 900. So how present value of 900 will also be calculated. But now his shares are not 1. His shares are 1.2. So 900 into 1.2. And again, it is given in the question that for both purchasing and selling, 5% incidental expenses are to be paid here. Incidental expenses at the rate of 5% will be given on both purchase and sale of shares. So for sale of shares also 5% is required to be paid. So it will be 900 into 1.2 into 95%. So it will be 1026. Now let us calculate all this. 1026 plus 10.85. Add all these figures. So it is actually coming to 5026. Again, this figure 1026 actually coming to 1026, and this 1026 will also be multiplied by the present value factor of the seventh year. It will be 463.75. So total it will be coming to 563.66. So it is the present value. From this, we will deduct the purchase price. From this, we will deduct the purchase price. Purchase price of is purchasing the shares. So it will be rupees 500. It has been purchased for 500. It is given in the question, that is thinking of buying at rupees 500. So 500 plus 5% of 500, because incidental expenses are also required to be given at the end of at the time of purchase. So it will be come to 525. So you deduct 563.66 minus 525, it will come to 38.66. Is coming to 38.66. So this is basically the capital gain. So the what the question is asking? The question is asking that whether Mr. A should buy the shares. The answer should be yes. Mr. Shea should be buy the shares because there is capital gain. And second part is what maximum price should he pay for the E shares? Maximum price the shareholder would pay. So it will be 563.66 into 100 upon 105. So it will be 563.66 into 100 upon 105. So it is basically 536.82. So final answer which is coming is 536.82. So this is the price at which the shareholder will be willing to buy. It is 100 upon 105 because the shareholder, why the shareholder will willing to buy at the inflated price, including the price of incidental expenses. He would be willing to buy at the price at which incidental expenses will not be there. So he will buy at this price, that is 100 upon, that is why 100 upon 105. Because this 563.5, this portion includes the incidental expenses. This portion is 105. So the maximum price would investor would be willing to pay is 563.66 into 100 upon 105, excluding the incidental expenses. So this is the question. Okay, there is one query. Sixth year, present factor same to say sixth year. Sorry, on the sixth year it will be 507. Sixth year it will be 507. Okay, now it is, I hope it will be clear to you. Any question regarding this? Okay, fine. Bonus point again, I will explain it again. See, what is given in the question? That Mr. A is expecting a bonus at the ratio of 1:5. Bonus issue is, bonus is 1:5. Means for 5 shares, one bonus is issued. One bonus share is issued. We are calculating this on the basis of one share only. So if 5 shares, if a shareholder is holding 5 shares, then one bonus share will be issued. For example, if a shareholder is holding one share, let us assume if one share, then zero point 0.2 bonus shares will be issued. So now his total share will be, one previously and now because of bonus issue 0.2. So it will be 1.2. Again, for one share, the dividend was 20. So for 1.2 share, it will be 20 into 1.2, it will be 24. So now I hope it is now clear to you. Okay. Now coming to the last portion, the question number 9. Last portion, the question number 9. First of all, just go through the question carefully. Just read the question. I will come back to the question. I will explain the question and then solve this. Welcome. I hope it is now clear to you. Okay. Now, come to this question, question number 9. Question number 9, it is said that Mr. A is holding 1000 shares of 100 each of ABC Limited. Mr. A is holding 1000 shares of ABC Limited. He wants to hold this for a long time. Now come to the second paragraph. On 1st of January, Mr. XYZ Mr. XYZ has made short sales of Messrs. ABC shares and approached Mr. A to lend his shares under stock lending scheme with following terms. Now, please try to understand this point carefully. That on 1st of January, XYZ wants to make short sales. There is a concept securities lending and borrowing in which the concept of short sale is used. It means selling the shares don't have when you don't have any shares. Such practices, short sales, is practiced in those situations where the seller who wants to short sale thinks that the market price will come down. Say, for example, he sells short, short it or sell it, short means sell, short it or sell it at rupees 100. And after, say, 1 month, it comes down to 80. So at this point, he can purchase the shares. So what is the purpose of the short seller? The purchase of the short seller is to sell at the current price because he knew that the price will come down. So he wants to sell it at the current price and purchase it later. But if he does not own the shares, what will happen? There is a facility under the securities lending scheme. So he can borrow it for some other person and he can sell. And then again, when the market prices come down, he can take the shares from that person and return it to him. For this purpose, the certain lending fee is charged. For example, in this case, A is lending to XYZ. A is lending to this XYZ. So what XYZ, and he lending to XYZ at rupees 1000. So what XYZ will do, XYZ will borrow and it will sell after borrowing it from A. Okay. Then after the prices come down, after price comes down, he will buy. He will buy those shares and return to A. Return to A. So what is the benefit of A? What A will be A's benefit? A's benefit will be lending fee. Because A is lending to XYZ. A is lending to XYZ. Therefore, XYZ will pay lending fee to A. So A's earnings will be lending fee. Okay. And XYZ expenses will be lending fee because it's paying to A. So what will be the income of A? First of all, A by lending it will get the lending fee. And what will be the total earning of A? It will be lending fee plus the dividend which he is getting. Again, at the last, we will be calculating the profit or loss. I think it will be clear to you. The third point, it will be clear to you after we gone through this first and the second point. Now let us calculate it. We have some sort of idea now of what this securities lending and borrowing is. Now let us approach the solution. Okay. If you see that there are two scenarios, bullish scenario 1, scenario 2. So we have to consider all this situation. Now we have said that what is the income of the A? A is lending. So A's income will be lending fee. And what is further given in the question? It is given in the question that share to be borrowed for 3 months. So we have to calculate this lending fee for 3 months. Lending charges, shares to be borrowed for 3 months. Lending charges is 1% lending fee, which the XYZ will pay to A. And bank guarantee is also to be provided. Who will provide the bank guarantee? It will be provided by XYZ, because XYZ is taking the shares on borrowing the shares. If he later on withdraws, अगर वो कहता है कि नहीं, I am not able to return the shares, then what will happen? There should be some safeguards. So some bank guarantee has to be provided by XYZ. Okay. What other information is given? Cost of borrowing is given. Cost of bank guarantee is given. ABC declared dividend of 25%. This 25% will be received by A. And closing prices are also given, ABC, for all this date. 1/1/2000 to 31 January, 29th February, and 31st of March. So first of all, find the earnings of Mr. A through lending scheme. What Mr. A is doing? Mr. A is lending the shares to XYZ. So Mr. A's earning will be lending fee. So first of all, calculate how much lending fee Mr. A is getting. Let us take scenario 1 and scenario 2. First is lending fee. Lending fee, first of all, it will be calculated on 31/1/20. After 1 month, the lending fee will be paid. Scenario 1, it will be 1020 into 1%. 1% is the lending fee. And for scenario 2, it will be 980 into 1%. See, on 31/3/2020, this is the share price. On this, the lending fee will be payable in case of scenario 1. And on 31 of January 2020, this is the lending fee will be paid on 980. Lending fee given to you in the question, it is actually 1%. This lending fee is 1%. Okay. So this lending fee is calculated in case of scenario 1. This is scenario 1. This is scenario 2. So scenario 1, it is coming to about 10.2, and scenario 2, it is coming to 9.8. Again, calculate it for 29/2/2020. Let us see the question. On 22nd of February, 29th of February 2020, this is the share price 1040. So lending fee will be calculated, 1% will be calculated on 1040 in scenario 1. And on 29th of February 2020, lending fee in case of scenario 2 will be calculated on this 960, 1%. Okay, now let us calculate it. So 1040, this amount, 1040 into 1%, into 1%. And in case of scenario 2, this 960. So it will be 960 into 1%. Again, on 31st March, lending fee will be calculated. C. 31st of March, this 1050, scenario 1, 1050 into 1%, scenario 2, 940 into 1%. And so this is basically 10.5 in case of scenario 1 and 9.4 in case of scenario 2. Let us total it, how much it is coming. It is coming to 31.1 in case of scenario 1 and 28.80 in case of scenario 2. So that this is lending fee per share. Now, what is the total number of shares? Total number of shares. It is given in the question. Total number of shares. Given in the question. Total number of shares. 1000 shares. Okay. So total number of shares 1000. We multiplied 1000 with the lending fee per share. It is coming to, this is the total lending fee. It is coming to 31,100 and it is coming to 28,800. We will put it as point A. It is lending fee per share. Now come to the second point. Second point in the question. What the second point is asking in the question? Second point is asking that total earnings of Mr. A during 1/1/2000 to 31/3/2000. Total earning means not only lending fee but also the dividend also. So let us calculate it. Total earnings. Dividend income. Just denote it as point 2. This is scenario 1 and this is scenario 2. In both the cases, the dividend income is actually coming to 25. The dividend income is coming to 25. Give me a second. Okay. Because here it is the given in the question itself that the dividend income is actually 25%. This dividend income is 25% and it is calculated on the face value. This face value is the face value is given in the question, that is rupees 100. So 100 into 25%, it will come to 25. So dividend will be 25 in both these situations. And then total earnings. So total earnings will be A plus B. A plus B, that is the lending fee plus dividend, both will be the income of A. So it will be 56.1 in case of scenario 1 and 53.8 in case of scenario 2. Total number of shares. Total number of shares 1000 in both these cases. So total earnings will be 56,100. In this case 53,800. I hope up to this it is clear to you that in first situation we calculated the lending fee which A will get from XYZ, because A is lending to XYZ. So XYZ will pay the lending fee. The lending fee will be the income of A. In second situation, we have calculated the total earning. That is not only the lending fee, but also the dividend income, which A is receiving. Now come to the third situation, third part of the question, in which it is asking the profit and loss. See, the third position, third question, part of the question. What is the profit and loss to Mr. XYZ by shorting the shares? Now let us tell me that when XYZ will get profit. XYZ will get profit only when the shares will come down. At what price he has shorted? Mr. A at 1000. At 1000. He taken the shares from A, XYZ, and then shorted it or sell it at 1000. Only when the price is below 1000, then he will able to get profit, because then he will able to buy. Why? Because after buying it from XYZ, after buying it from A, only then will it can return the shares to A, which he had borrowed it from him. Okay. Now let us calculate the profit or loss. Profit or loss to measures XYZ. Loss I have indicated in the bracket. So it will be 1050. Scenario 1, scenario 2. 1050 minus 1000, the scenario 1, and it is 1000 minus 940 in case of scenario 2. If you observe the question carefully, see here. In scenario 1, XYZ is actually suffering losses. Why? Because he has sorted it at 1000. He has sorted it at 1000, but now he has to purchase it at 1050. He has sorted it at 1000, but now he will have to purchase back at 1050. Why? Because prices on this date, 31st of March 2020 is 1050. So he has to purchase at 50 rupees higher. He shorted it at 1000, but now he has to purchase it at 1050 because the lending period is for 3 months only. So at the end of the 3 months, the prices have not fallen down in scenario 1. The prices have increased from 1000 to 1050. So there is a 50 rupees loss to XYZ, which has taken the shares on loan. Okay. So that is why this is this figure 1050 minus 1000. This is in the scenario 1. So scenario 1, it will be 50 loss. In scenario 2, it is a profit to XYZ. How? Here, if you see that he has shorted it or sold it for 1000 XYZ by borrowing it from A. But at the end of the 3 months, the lending period, the share prices have come down from 1000 to 940. So this is the profit to A. How? Because he is getting the shares at 60 rupees less. Because at that time he has to purchase it in order to give the shares back to A. So XYZ now can purchase at 940. He sold it at 1000 and now can purchase it at 940, 60 rupees less. So this 60 rupees is a profit to XYZ. So 60 rupees is profit. That is 1000 minus 940. Again, in case of XYZ, lending fee is a expense. Lending fee is a you can say expenses on the part of XYZ. So lending fee 31.10 in case of scenario 1 and 28.80 in case of scenario 2. Again, bank guarantee. Bank guarantee has to be given by XYZ because XYZ is borrowing the shares. If he backs out, then what will be the security? So in order to secure himself, he will want a bank guarantee. So bank guarantee also has to be given by XYZ. And this cost of bank guarantee, it is given in the question that cost of bank guarantee is 8%. So this will be, and this will for 1000 only because the total amount is 1000. So 1000 divided by 4, that is 250 multiply into 8%. So it is 250 into 8%, which is actually coming to 20. Total amount is 1000, but we are taking it as only for 3 months only. So 250 into 8%, which is coming to 20 rupees in scenario 1 and scenario 2. So now calculate the total gain or loss of both A and B in the situation scenario 1 and scenario 2. So in case of scenario 1, the total gain, the total loss is 101.1 because all these figures are in the minus. But in case of scenario 2, there will be a gain of 11.2 to XYZ. And total shares is 1000 in both the cases. So total gain or loss will be 1000 multiplied by 101.1. This is actually gain or loss per share. Gain or loss per share. Total gain or loss, it will be 1,01,000. And it will be loss, 1,01,000 loss, and it will be 11,200 profit. Okay, so this is what about this question. Question number 9. I hope it is clear to you. We once again try to solve this question after this lecture. And if any point regarding this, if you find it difficulty, please write to us. You can you can say download the mobile app, US mobile app, where you can post your queries, or you can also call at 0120 3045 956. So this is the number at which you can call, and if any difficulty you face, you can please coordinate us. So, Ashish sir,
Thank you. Thank you, Vivek sir,
thank you,
for
sir.
your wonderful session. And there was regarding question number 6. I was saying that same question, some portion of the same I have got solved in my lecture also, where we have discussed the concept of sustainability growth. Now here, how we have used sustainability growth to value the equity is an important part of it. Now, student, Vivek sir has discussed one part of the security, that is equity, with you. Now, in a forthcoming class, we shall discuss the another aspect of the security valuation, that is related to fixed income securities. So, student, in this forthcoming session, we shall discuss fixed income securities, where various how we value the securities and various aspects we shall discuss. So, student, if you have any query, Vivek sir, you have shared the phone number.
Yes, sir. It is phone number. It is in front
Yes.
of you.
So Vivek sir has shared with you the phone number with you. So you can send any contact me or at this number, or you can send your queries at mobile app. So we shall see you in the next session, where we shall continue this topic of security valuation, and we shall take up the evaluation of fixed income security. Thank you, Vivek sir, for your spending your precious time and taking the lecture, throwing the light on this very typical topic. Thanks a lot.
Thank you so much.